Okay, now we're going to give you a visual of the very same thing I just talked about, only the actual journal entries and postings that you do. So it might be a little bit redundant, but this is just another way of looking at the accounting cycle for one period. So let's begin. The first 4 slides just show the actual transactions as they were journalized for April. As you can see, you've got cash. I mean, they're just all laid out. Here's your expenses, your receivables, your revenues that came in. So all of these were journalized and put into the general ledger. After they were into the journal ledger, they were then pulled off for an unadjusted trial balance. And as you can see, it proved its point. It is balanced. The next thing they looked at for the end of the period was, well, we have to do adjustments. And see, they've pulled the unadjusted trial balance off and put it here. Then they've completed the adjustments, just like here. And here are the journal entries for those adjustments. You can see they've got prepaid insurance, supplies that they've used, depreciation, salaries that weren't paid yet, rent expense, which is a prepaid rent that they had, and then they had unearned fees that were put in. So after they've done that, then they have the adjusted trial balance, which shows right here. See, now we've got the adjusted trial balance. So now we're ready to pull off the financials. And the financials end up looking like this. Fees earned, 23, and then your expenses, and then the net income. So now what happens with this net income? It gets, wait a minute, I missed one. It gets pulled down and put into the statement of owner's equity accounts, right? Or capital account here. And they subtract the withdrawals that were probably up here somewhere that I didn't see. Here it is, right here. Here's your withdrawals. And that gives us a brand new capital account amount, which then gets transferred down to the balance sheet. And again, this is classified balance sheet. It's got subcategories set out, and it balances, so we know that things have been done correctly. From there, we're going to do closings, which means we're going to affect accounts again. So remember, we want to empty out all the temporary accounts, which would be revenues and expenses, and we're going to put that into another temporary account called income summary. So fees are debited, the income summary is credited, all the expenses are credited, income summary is debited. The difference between those two is what? Probably this number right here, and that's the net income. That gets added to the capital account here, and then the withdrawals are taken out. We then have to make sure that we have everything in balance because we've created and manipulated or modified the account balances. So we pull off a post-closing trial balance, which looks exactly or has the same amounts and accounts as a balance sheet. Only it is not classified. It's just all assets, all debits on one side, and all credits. And that basically is a visual of the actual accounting transactions that are used for an accounting cycle.